Right, students. Right, now still we are in grade 11, chapter 1, trade and supportive services. Under the trade and supportive services, already we have discussed trade. Trade we have done. And then under the supportive services, last day we completed banking. Services related to banking. We discussed last day. Okay, under the banking, what we discussed? We discussed some of the services offered by commercial banks. Some of the services offered by commercial bank. Commercial bank. Right, Lamai? Commercial bank provide, okay, especially commercial bank provide two services, two main services, according to our syllabus. According to our syllabus, a commercial bank provide main two services. According to our syllabus, huh? Lamai? One is services related to deposits. Other one is services related to electronic cash. Services related to deposits and services related to electronic cash. Okay, right. Dear students, we discuss services related to deposits as well as electronic cash. Under deposits, we discuss savings account, fixed deposit account, and current account. And then we discuss how to open savings account, how to open fixed deposit account, and then how to open current account. We discuss. We have discussed required documents as well. Required documents and advantages of savings account, fixed deposit account, and current account. We have discussed. Not only that, we discussed we discussed meaning of checks, crossing a check, endorsement of checks. Okay, we have done. And then we discuss electronic cash. Under electronic cash, debit card, credit card, then ATM card. ATM card. Lastly, we discussed short note also. Short note also. Okay, matters available in the short note also we discussed last day. Yes, today we need to discuss insurance. Insurance. Students, we have main four supportive services. We have main four supportive services that we need to discuss in our syllabus. First supportive service is banking. Second one is insurance. Third one is communication. Fourth one is transportation. Banking. Today we'll discuss insurance. Today we'll discuss insurance. Right. Now, what do you mean by insurance? Insurance means students. Right, now insurance. We can insure our risk. We can insure our risk. In an insurance organization. If you have a motor vehicle, you can insure your motor vehicle in an insurance organization. And then if something happened to that motor vehicle, insurance company pay compensation. Insurance company pay compensation. Compensation means claim. Insurance company pay claims. Compensation. Basically, one euro again. Insurance company pay compensation. Claims. Okay, if something happened to that vehicle, if that vehicle met with an accident, insurance company pay compensation claims. They pay claims or compensation. Okay, and then insurance. There are different kind of risks in our life. In our life. Okay, there are different kind of risks related to our life as well as our property. As well as our property. Okay, accidents, sometimes natural disasters. Okay, likewise, now there may be different kind of risk to our life as well as to our properties. There are different types of risk. Then because of those risks, we will have to spend if something happened to our life, if something happened to our property, we will have to spend money to recover the damage. We will have to pay money to recover the damage. Then insurance company provide us a solution to recover that damage. Or insurance company pay money to recover our damage. To recover our damage. They pay money. They pay money to balance financial losses. To balance financial losses arise because of that accident or something. Okay, insurance company pay money to recover the loss. To recover the loss. Insurance in our life. Okay, now there are two types of risk. There can be different kind of risk. Out of those different type of risk, there are two types of risk. Is insurable risk. One is insurable risk. One is insurable risk. Insurable risk. We can't insure all the risk. We can't insure all the risk. Therefore, there are two types of risk. One is insurable risk. Other one is non-insurable risk. Non-insurable risk. There are two types of risk. Insurable risk and non-insurable risk. Insurable and non-insurable. Insurable risk means risk that we can insure. There are some of the risk. Loss of love. Loss of love. Loss of love. Loss of love affair. We can't insure. We can't insure. Failing exam. Failing exam. Failing exam, we can't insure. Failing exam, we can't insure. We can't insure. We can't insure. Okay, we can't insure. If someone cannot pass O-level examination, we can't insure. That is totally depend on his skill. That is totally depend on his skill. But without studying, Without studying, someone going to face the examination. Then he can't get minus. Then he can't pass exam. Then failing exam we can't ensure. Loss or love we can't ensure. Now, damage to our good name. Damage to our good name. Damage to our good name. Okay, Lamai, damage to our good name we can't ensure. Damage to our good name we can't ensure. Now, their financial value we can't measure. We can't measure the financial value of loss of love. Okay, loss of love. Now, there are risks that can be insured and that can be insured and that cannot be insured. Now, if we can measure financial value of something, then we can insure some of the risk. Okay, for example, let's say damage to your vehicle. Damage to the vehicle you can insure. Why? You can measure the financial value. You can measure the financial value. Okay, right. There are two types of insurance risk. There are two types of risk. Insurable risk and non-insurable risk. Okay, insurable and non-insurable. Right, right. Then in our syllabus we discuss only insurable risk. Only insurable risk. Then what do you mean by insurance? Insurance means what? Insurance means insurance means people having different risk. People having different risk. Persons having different risk. Persons having different risk. Okay, people having different risk. Let's say A, B, C, D, E, F. Persons having different risk pay premiums, premiums. Okay, people having different risks pay premiums to a insurance fund. Okay, persons having different risks pay premiums. Premium is let's say insurance installment, insurance payments. The technical term is premium. Okay, people having different risks pay premiums, pay payments to an insurance fund. Okay, people having different risk pay some amount to a fund. Some amount to fund. People having different risks pay premiums to a fund. To an insurance fund. And then if something happened to, let's say, person C. If something happened to person C. If something happened to C's property. If something happened to his property or his life, using this fund, insurance company pay. One of the insurance company manage this fund. If something happened to person C, insurance company pay compensation. Compensation means insurance claims or compensation. Insurance company pay compensation to person C. Person C. They collect premiums from different persons. Different persons. Therefore, they have a huge fund. Using that fund, they pay compensation to person C. Compensation to person C. They have a huge fund. Using that fund, they pay compensation to person C. That's the meaning of insurance. Tamai, collecting premiums to a separate fund. Collecting premiums to a separate fund. Tamai, collecting risk to a fund. Collecting risk to a fund. Collecting risk of different persons to a fund through insurance premiums. They collect risk to a insurance fund through insurance premiums. That is called risk pooling. Risk pooling. Risk pooling. They gather risk. They pool risk. They gather risk into an insurance fund. Into an insurance fund. That is called risk pooling. Collecting risk to this fund. Okay, therefore this is called risk pooling. Risk pooling. Collecting risk. Accumulating risk into an insurance fund. Into an insurance fund. Okay, insurance. So this is called risk pooling. Risk pooling. Risk pooling. If something happened to one person, okay, compensation is paid using this fund. That is the meaning of insurance. Ramai, let's say, for example, let's say, C received 20 million. C received 20 million. Let's say, Ramai, something happened to C's motor vehicle. Then to repair that motor vehicle, it required 2 million. 2 million. Then my insurance company paid 2 million to C to repair his vehicle. Let's say he has a Range Rover. To repair that Range Rover, he required 2 million. 2 million. Insurance company paid 2 million to person C. But insurance, C, he need not to pay 2 million to insurance company. Sometimes he may have paid 100,000 as insurance premium. 100,000 or 50,000. He has paid 50,000 of insurance company. 50,000. Okay, 50,000 as insurance payment. But if something happened to his motor vehicle, insurance company pay 2 million to C. How they pay 2 million? Using this 50,000. Ramai, to this fund, different persons pay compensation. Sorry, different persons pay premiums. They have a huge fund collected from different persons. To get the insurance policy, she paid only 50,000. But compensation is 2 million. Using that huge fund, insurance company pay compensation. Then insurance. Then here the meaning is, okay, here the meaning is the loss of 2 million. The loss of 2 million of person C shared among others. Insurance company pay compensation to C using this fund. To this fund, different persons pay premiums. It means C's loss shared among others. Shared among others. Why? Using others' money. Insurance company pay compensation to C. His loss shared among others. Person C's loss shared among others. Shared among others means using others' fund. She also has paid 50,000 to insurance company, insurance fund. But using everyone's fund, insurance company pay compensation to person C. Pay compensation to person C. Okay, right. Right. Therefore, here it can be considered as his loss shared among others. Shared among others. His loss shared among others. This is called risk pooling. Pooling of risk. Pooling of risk. Right. Now we can move into the textbook. Now I go to page number 18. Go to page number 18. No. No power. No need to pay 2 million again to insurance fund. He has obtained insurance policy by paying 50,000. But insurance company different 50,000. 50,000, 100,000 maybe. Okay, depending on the value of property, property, they receive premiums from different persons. Okay, they have a huge fund. Using this fund, she need to pay only 50,000 to insurance company to get the insurance policy. No need to pay again 2 million to insurance company. No need to pay. Okay, right. Right. Right, Gamai, right. Go to page number 18. Go to page number 18. Page number 18. Can you read this note? Vinod, can you read this note? Vinod, first para, Vinod. Insurance first para, Vinod. Swani, can you read this note? Swani.
Every individual as well as every businessman has to face risk. It is impossible to identify with certainty when or where those risks would occur. Instant fires, storms, floods, tsunamis, earthquakes, accidents, and droughts are some risks.
Right, now every individual as well as every businessman has to face risk. Has to face risk. It is impossible to identify with certainty. When or where those risks would occur. We don't know exact date. Instant fires, storms, flood, tsunami, earthquake, accidents, riots are some such risks, some of the risks. that may come across in your life. Okay, instant fires, storms, flood, tsunami, earthquake, accidents, riots, some kind of risk. Some kind of risk. Okay, some kind of risk. Right. Then students, go to page number 90. Go to page number 90. Page number 90, first paragraph. Sanukar. Page number 90, first paragraph. Sanukar. First paragraph, Sanukar. Power, first paragraph, power.
In order to face these risks, a systematic method should be adopted. Insurance institution give systematic method to minimize these risks.
In order to face to these risks, a systematic method should be adopted. We require systematic method. Insurance institution give minimize these risks. Actually, not to minimize this. They give systematic method to minimize financial loss. Actually, insurance company cannot remove the risk. They can't remove the risk. But what they can do, they can provide us a systematic method. Okay, systematic method to manage financial losses happen due to those risks. Okay, they can something do for financial loss. Okay, now I read it again. In order to face to these risks, a systematic method should be adopted. Insurance institution give a systematic method to minimize these risks. Actually, they provide us a systematic method to balance financial losses. Okay, to balance the financial losses. Right, Lamai? Page number 19, second para. Page number 19, second para. Power.
The basic of insurance is accumulating risk. The insurance collects premiums from individuals who anticipate different risks and pay compensation from that common fund to those individuals who have faced this risk indefinite. Insurance accumulates the risk of all into a single insurance fund. Hence, insurance is known as a pool of risk.
Yes, come here. The basis of insurance is accumulating risk. The basis of insurance is what? Accumulating risk. Accumulating risk to this fund. Okay. The basis of insurance is what? Accumulating risk. Collecting risk. Accumulating risk. Okay. Now here, the basis of insurance is accumulated risk. The insurance collect premiums from individuals who anticipate different risks and pay compensation from that common fund to those individuals who have faced these risks indefinitely. Here, insurance company collect premiums from individuals who anticipate different risks and pay compensation from that common fund. Using that common fund, insurance company pay compensation. Okay, right, compensation from that common fund to those individuals who have faced these risks indefinitely. Using the insurance fund, insurance company pay compensation to that person. Next one. Next one. Here, insurance accumulate the risk of all into a single insurance fund. Hence, insurance is known as a pool of risk. Pool of risk. Right, come on here. Here, insurance accumulate the risk of all into a single insurance fund. Okay, now insurance accumulate the risk of all into a single insurance fund. Now, to this single insurance fund, insurance accumulate the risk of all into a single insurance fund. To this insurance fund, insurance company collect risk. Hence, insurance is known as pool of risk. Pool of risk. Okay, now insurance company collect risk to this insurance fund. Therefore, that is called risk pooling. Risk pooling. Risk gathering. Risk pooling or risk gathering. Risk gathering. Okay, right. Come on here. Please highlight this sentence. Insurance accumulate the risk of all into a single insurance fund. Hence, insurance is known as a pool of risk. Right? Please highlight that one. Okay, right. Now next para. Third para. Page 90, third para. Nilupuli, third para. Nilupuli.
Insurance is established to share financial losses among the participating individuals of the insurance fund of one or few individuals who have won a risk with difficulty. Insurance is a pool of risk where the losses of one party are shared collectively. This is an agreement between two parties.
Right, insurance here. Insurance is established to share financial losses among the participating individuals of that insurance fund of one or few individuals who have won a risk with difficulty. Insurance is established to share the financial losses among the participating individuals of that insurance fund of one or few individuals who have won a risk with difficulty. One of the person's loss shared among others. Shared among others means using their funds. Insurance company pay compensation. Insurance company pay compensation. Here I read it again. Insurance is established to share the financial losses among the participating individuals of that insurance fund of one or few individuals who have won a risk with difficulty. Using others' fund, insurance company pay compensation to that relevant fund. Okay, and then here, insurance is a pool of risk, a collection of risk, pool of risk, where the losses of one party are shared collectively. Losses of one party shared collectively among others. This is an agreement between two parties. Okay, right. Now we'll discuss page 19. In page 19, you can see parties involved in insurance. Different parties involved in insurance. Right, now for the different parties involved in insurance agreement, there are only two parties. First party is okay. Now first one is first party. Second one is second party. Third one, third party. First party, second party, and third party. There are three parties involved in an insurance coverage. First party, second party, and third party. Actually, third parties are not involved in. This is an agreement between first party and second party. Now, my first party means us. Us. If Binili obtain an insurance coverage from Selinco Insurance Company, Binili first party. Binili first party. Selinco Insurance Company, second party. Selinco Insurance Company, second. Okay. Now, my first party. First party means the person who obtained the insurance coverage. First party means the person who obtained the insurance coverage. First party. Second party means insurance company. Third party means all the other parties except first party and second party. Third parties. Okay. First party, second party, and third party. First party is called insured. Insured. The person who obtained the insurance policy. Insured. First party. Let's say Himandi obtained an insurance coverage. Then first party Himandi. Insured Himandi. And then insurance. Let's say Selenco Insurance Company. Selenco Insurance Company insurer. The party who provided insurance agreement, insurance policy. Second party, insurance company. Actually, insurance company. Selenco Insurance Company. Okay. Famous insurance company, insurance company. Second party. Third party, all the other parties. Okay. If you are running the bus, all the passengers in the bus, third party. All the passengers in the bus, third party. All the other parties, outsiders, all the outsiders. Other than first party and second party. Okay, third party. All outsiders. Okay, right. Right, we can move into page number 19. Parties involved in an insurance. Parties involved in an insurance. First party. Can you read the note? First party. Netuki. Netuki, read this first part, Netuki. First party.
The party who obtains the insurance coverage, the insured.
Now, please highlight insured. The party who obtains the insurance coverage, insured. Okay, insured. Right. Second one. Methular. Second one, Methular.
Second party, the party who provides the insurance coverage, i.e. the insurer is the insurance company.
The party who provides the insurance coverage. That means the insurer is the insurance company. Second party is the party who provides the insurance coverage. Actually, insurance company. Third one, third party. Third party, regional, third party, Gerard, third party, Gerard.
All the other parties and properties that are affected by an insurance contract, for example, the passengers and other vehicles on the roads, will become the third party when a vehicle is insured.
Right, now third party, all the other parties and properties will be affected by the insurance company. If you are running a vehicle, all passengers will have to third party. In insurance coverage, what are the parties involving? First party, second party, and third party. Insured, insurer, and all the other parties, third parties. Okay, ne? Right, right, right. Now we can move into principles of insurance. Before go to principles of insurance, we will get a break. We'll get a small break. Now we will to move into principles of insurance, but we will get a break. Now only 5 minutes break. Right, now I will start. We'll start. And then insurance, there are 3 parties involved in an insurance coverage, especially first party and second party. First party and second party, and then all the other parties are called third parties. Third parties. Okay, all the other parties are called third parties. Okay, right. By the insurance, right, look at the note again here, page 19. Right here, first party, the party who obtained the insurance coverage, the insured. Lama, you need to highlight insured. You need to highlight insured. Highlight insured. And then insurance. Right, second party insurer. Second party insurer. Insurer means insurance company. Insurance company. Okay, second party insurer. Right. Third party, all the other parties and properties will be affected by an insurance contract. Third party. Okay, right. Actually, this is an agreement between 2 parties. Agreement between first party and second party. Insured and insurer. Insured and insurer. Okay, right. The insurance will move into principles of insurance. Now, insurance industry, insurance business totally depend on 6 insurance principles. Insurance industry totally depend on 6. Right. Right now, insurance industry totally depend on 6 insurance principles. 6 insurance principles. Okay, 6 principles of insurance. Out of these 6 principles of insurance, in our syllabus, you need to learn only 3 principles. Only 3. Out of 6, only 3 need to study in your syllabus. Okay, right. What are they? Okay, those are the main principles of insurance. Main principles. One is insurable interest. Insurable interest. Other one is utmost good faith. Utmost good faith. Other one is indemnity principle. Okay, Lamai, insurance business totally depend on 6 insurance principles. Out of those 6 principles of insurance, in our syllabus, we need to learn only 3 main insurance principles. What are they? They are insurable interest, utmost good faith, and indemnity principle. Indemnity principle. Okay, right? These are the principles. Okay, insurable interest, utmost good faith, and indemnity. Insurable interest, utmost good faith, and indemnity. These are the main three principles that we need to discuss in our syllabus. Okay, right. Now, other than these three, okay, there are three principles. They are, one is subrogation, proximity reason, another one is contribution. Subrogation, proximity reason, and contribution. But those three principles are not required to discuss in our syllabus. Those three belongs to advanced level syllabus. In our syllabus, we need to learn only these: insurable interest, utmost good faith, and indemnity principle. Okay, right. Right now we will look at one by one. Okay, these principles. Right. First one is, students, insurable interest. First one is insurable interest. What is that? Insurable interest means, students, there should be a legal right. There should be a legal right to insure something. Legal right. There should be a legal right to insure something. Legal right. There should be a legal bond to insure something. For example, for example, husband can insure wife. Husband can insure wife. There's a legal contract. Your mother can insure father's life. Father can insure mother's life. Husband can insure wife's life. Wife can insure husband's life. If something happened to husband, insurance company pay compensation to wife. If something happened to wife, insurance company pay compensation to husband. They have a legal contract. Legal contract. There should be a legal contract. Okay, there should be a legal right. Right to legal contract. Legal right. And then insurance. And then another one is, let's say property owner should have a legal right to insure his property. Amrit can insure his motor vehicle. Amrit can insure his V8 motor vehicle. Jetpika can insure his land cruiser. He is the legal owner. Legal owner. Bidili can insure her house or building. Legal owner. Legal owner is the Bidili. Now, there should be a legal right to insure something. To insure a life or a property. But insurance, this insurance industry, insurance companies do not allow to insure here insurance. Okay, this concept, insurance companies do not allow to insure children by their parents. It means insurance, parents cannot insure their children. Parents cannot insure their children. Children's life. Children cannot insure their parents' life. Why? Your parents can insure, they can get medical coverages for you. Medical coverage. If you hospitalize, insurance company will pay some amount to your parents. They can get medical coverages and some of coverages. Otherwise, parents cannot insure children's life. Children's life. Now it means life insurance. Okay? Children's life means if something happened to your life, due to death of children's life, parents cannot get compensation. Due to death of parents' life, children cannot get compensation. They can't get compensation. It means children cannot insure his parents to get compensation. Okay? But parents can get insurance coverages for their life. Then if something happened to their life, dependents can get claims. Dependents. Okay, Ramai? Let's say Ramaya, parent, one of the parent. Let's say Ramai, let's say Kamal. Okay, Kamal. One of the parent, his name is Kamal. Kamal's son is, let's say Kamal's son is Nimal. Kamal's son is Nimal. Kamal cannot insure Nimal's life. Nimal cannot insure Kamal's life. Okay, but Kamal can insure his life by himself. Kamal can insure his life by himself. If something happened to Kamal's life, something happened means death. Nothing else but death. Okay? If something happened to Kamal's life, Nimal can get compensation because Nimal is one of the dependent. When Kamal getting the insurance coverage, he need to nominate, he need to mention on the insurance contract. He need to mention on the insurance policy, if something happened to me, pay the compensation to Nimal. If something happened to Kamal, okay, pay compensation to Nimal. Why? Nimal is my son. He can nominate, he can name a dependent for his insurance coverage. Then Nimal can get compensation.
Excuse me, sir.
Yes.
Sir, if Nimal is nominated by Kamal, for whom is that compensation money going?
Insurance company pay compensation to Nimal.
Sir, if his name is not mentioned,
If name is
not mentioned by Kamal,
normally when you're getting insurance policy, you need to mention nominees. Okay, you need to mention nominees. And then some of the family members, if family members can prove, okay, by proving some family members also can get compensation. Okay, then family members need to prove that they are as family members. If they can prove, they can get compensation. Okay, otherwise, Nimal cannot insure Kamal, and then he cannot get compensation. Kamal cannot insure Nimal life to get compensation. Okay, normally one of the accepted common principle is parents cannot insure children's life. Children cannot insure their parents' life. Okay, in the exam, no need to write the reason for that. No need to write the reason for that. You need to know your parents cannot insure your life. Okay, now there are some insurance legal cases in the world. Parents have insured their children to get compensation, and then they have killed their children to get the claim. Parents have insured their children, and then they have killed their children to get compensation. And on the other hand, also, children have insured their parents, and then later they have killed their parents to get insurance compensation. To avoid that kind of things, in insurance, parents cannot insure their children, children cannot insure their parents. But parents can get medical coverages to their children. Children can get medical coverages covering their parents. If they hospitalized, okay, insurance company will pay some amount for them. Clear? Okay. Now, insurable interest means there should be a legal right to insure something. There should be a legal right to insure something. Okay. Right. Let's say right. Okay. Right. And then let's say one of the person, let's say Vimal. Okay, I'm not going to get example again from the students list. From the student list, in my physical classes, I am getting examples from the students list. But because of this online class, I'm not going to give. I'm not going to get examples from you. Now, let's say Vimal cannot insure his girlfriend. Why? There is no legal contract. His girlfriend cannot insure Vimal. Why? There's no legal contract. Without having a legal contract, you can't insure girlfriend. Okay, no legal. There should be a legal right to insure something. Legal right. Right, now, in insurance, a creditor can insure debtor. In insurance, creditor can insure debtor. Creditor can insure debtor up to the value of credit limit. Up to the value of credit limit. A creditor can insure debtor up to the value of credit limit. Let's say like this. Let me explain. Let's say my creditor. Let's say my Sampath Bank. Sampath Bank. Sampath Bank provided the loan to Sampath Bank provided loan 1 million loan to Kamal. 1 million loan to Kamal. Sampath Bank creditor, Kamal debtor. Sampath Bank creditor, Kamal is a debtor. Sampath Bank offered 1 million loan to Kamal. The insurance. Kamal can, sorry, Sampath Bank can insure Kamal up to 1 million rupees. Sampath Bank can insure Kamal up to 1 million rupees in an insurance company. Let's say in the Selinco insurance company, Sampath Bank can insure Kamal up to 1 million rupees. Why? If something happened to Kamal's life, Sampath Bank cannot recover this 1 million. If they can't recover this 1 million from Kamal due to death of Kamal, then insurance, Sampath Bank collect unpaid amount by Kamal from Selinco Insurance Company. Insurance, a creditor can insure debtor up to the value of credit limit. Is it clear? Now, my insurance limit is clear or not? Clear. Abdullah, clear.
Yes, sir.
Clear. Okay. Clear. BDD clear, BDD?
Yes, sir.
Yes, Smith, right. Hania, is it clear, Hania?
Yes, sir.
Yes. Gerard, clear, Gerard?
Yes, sir.
Power, clear, power.
Yes, sir.
Yes, right. Right. Now, there should be a legal right to insure something. There should be a legal right. Right, we will read the note. Look at the note. Look at the note. Himandi, read the note. Himandi, league insurable interest. Himandi.
The legal right to obtain an insurance coverage for a life or for property is known as insurance interest.
Yes. The legal right to obtain an insurance coverage for a life or for property is known as insurable interest. Come on, please highlight legal right. Now, please highlight legal right. Legal right. Okay, legal right. Right. The legal right to obtain an insurance coverage for a life or property is known as insurable interest. Yeah, should be a legal right. Right. Then here example, husband and wife have insurance interest for each other's life. Second one, in property insurance, the legal owner of such property has an insurable interest. In property insurance, the legal owner of such property has an insurable interest. Legal owner. And next one, a creditor has an insurable interest over the life of the debtor up to the value of loan. Okay, a creditor has an insurable interest over the life of the debtor up to the value of the loan. Okay, right. Now, insurable interest. Right. Now we can move into next one. Utmost good faith. Right now, utmost good faith means insurance Insurer, insured and insurer. Insured and insurer. You and insurance company. Insurance company. You and insurance company. Insured and insurer need to explain all the relevant information regarding the insurance contract. You need to disclose your information to the insurance company, and insurance company need to disclose relevant information regarding the insurance contract to you. That is mean by utmost good faith principle. Utmost good faith. Both parties need to disclose all the relevant information. All the relevant information. Okay, both parties need to disclose all the relevant information between each other. Utmost good faith. Okay, right. There is some kind of a simple principles of insurance. So, come on, we'll read. Like Hania. Hania, read this note, Hania.
Utmost good faith. This principle states that both parties to the insurance contract should disclose all the relevant information accurately for the contract. The parties involved in the contract are the insurer and the insured. The insurer and the insurance company and the insured is the party who has obtained the insurance coverage. If either party does not disclose any important information, it will be a breach of utmost good faith. Then both parties have the legal right to cancel the insurance contract.
Right, Raman here. This principle states that both parties to the insurance contract should disclose all the relevant information accurately for the contract. Raman, please highlight. Both parties to the insurance contract should disclose all the relevant information accurately for the contract. Okay, both parties to the contract, insurance contract, should disclose all the relevant information accurately for the contract. Please highlight. And then the parties involved in the contract are insurer and insured. The insurer is the insurance company. Sheniko Insurance, Jalashakti company. Okay, insurer is the insurance company, and the insured is the party who has obtained the insurance coverage. If you obtain an insurance coverage, you are the insured. If either party does not disclose any important information, students, both parties need to disclose all the important information. It will be a breach of utmost good faith. It will be a violation of utmost good faith principle. Breach, violation. Okay, it will be a breach of utmost good faith principle. Then both parties have the legal right to cancel the insurance contract. Okay, if one of the party violated utmost good faith principle, then both parties have the legal right to cancel the insurance contract. Okay, right? Neither utmost good faith principle it means both parties need to disclose all the relevant information each other. That is the idea of utmost good faith principle. Okay, right. Now, look at the next one. Indemnity principle. Look at the next one. Indemnity principle. Right, now, indemnity principle means. Right, now, let's say Sanuka. Let's say Sanuk has insured his motor vehicle. Sanuk has insured his motor vehicle. Let's say value of his motor vehicle is 5 million rupees. 5 million rupees. Value of the motor vehicle 5 million rupees. 5 million rupees. Value of the motor vehicle. To this, to insure this 5 million worth of motor vehicle, let's say he has paid insurance premium 100,000. 100,000. By paying 100,000 to insurance company, he has obtained 5 million coverage. 5 million coverage to his motor vehicle. Let's say the motor vehicle met with an accident. Okay, met with an accident. So then, to repair the motor vehicle right now, it requires 1,500,000. To repair the motor vehicle, it requires 1,500,000. 1.5 million. 1,500,000 required to repair the motor vehicle. If 1,500,000 required to repair the motor vehicle, insurance company will pay only 1,500,000. Insurance company will pay only 1,500,000. Okay, right? To repair the damage, to come to the previous level, to reinstate the damage, to come to the previous level, insurance company pay compensation. Okay, right now here, in our example, only 1,500,000. They pay only 1,500,000 to come to the previous level, to reinstate the damage, to repair the motor vehicle. The insurance here, insurance company does not allow you to get profit. You can't get profit through the insurance contract. Okay, now insurance companies do not allow to take profit through insurance contracts. Okay, therefore, to repair the damage, only to repair the damage, insurance company pay compensation. They pay claims. That is called indemnity principle. Okay, that is called indemnity principle. And other thing is, indemnity principle does not apply to life insurance. In life insurance, okay, insurance company cannot measure the value of life. Therefore, indemnity principle does not apply to life insurance. Okay, in properties, insurance company can measure the value of the property. By measuring the value of property, insurance company pay compensation. They can measure the loss. But in life insurance, insurance company cannot measure the value of our life. Therefore, in property insurance, indemnity principle apply to property insurance. In property insurance, insurance premium is decided by the insurance company. Let's say worth of the motor vehicle 5 million, then insurance company will ask you to pay only 100,000. In property insurance, insurance company decide insurance premium. But in life insurance, depending on our payment ability, depending on our income, we can decide insurance premium and relevant insurance amount. If you can pay 50,000 per month, let's say they will offer you 1 million coverage. For example, okay, let's say if you can pay 30,000 per month, they will offer you 4 million insurance coverage. 4 million insurance coverage. 4 million coverage means if something happened to your life, insurance company will pay 4 million to you or yours dependent. In life insurance premium decided by us. But in property insurance premium decided by the insurance company, depending on the property value. Now, one of my insurance parent paying monthly 300,000 insurance premium. Monthly 300,000 rupees for the insurance, for the life insurance policy. Monthly 300,000. Monthly 300,000. Okay, that is depend on our income in life insurance. Okay, right now, but in property insurance, value of insurance premium decided by the insurance company. Okay, if something happened to our life, or if some damage happened to our body, insurance company pay based on the agreement. Okay, we decided insurance premium. Then according to the insurance policy, they will pay claims to us. Okay, without considering the worth of our body part. They can't measure the body part. They can't measure the value of body. Okay, body parts. This is why, according to our insurance policy, according to our premiums, they will decide the compensation for us in life insurance. Okay, right. The insurance in indemnity principle to come to the previous level. To reinstate the damage, insurance company pay compensation. They pay compensation. Right now, read indemnity principle. Read indemnity principle. Right. Well, here, indemnity principle get me either not get me indemnity principle get me by someone else. Dilanka, indemnity principle, Dilanka.
The principle states that if a loss occurs to an insured property, the compensation paid should be sufficient only to reinstate the damage to the previous state. This principle does not apply to the life insurance.
Right, here, this principle states that if a loss occurs to an insured property, the compensation paid should be sufficient only to reinstate the damage to come to the previous level. To reinstate damage to the previous state. To come to the previous state. Compensation should be sufficient only to come to the previous level. This principle does not apply to life insurance. Here example, when a motor vehicle having a value of 2 million is insured for the same value, the compensation of 500,000 can only be obtained for damage value 500,000. If the value of the damage is 500,000, insurance company will pay only 500,000. Only 500,000. Right? Indemnity principle. Right. Third principle, indemnity principle. Right. Right. Is it clear? We know clear. We know. Suwani, Power clear. Sanuka clear.
Yes, sir.
Yes, sir. Right. Nituki, Metula clear.
Clear, sir.
Clear. Right. Right. Furnace Faisal, clear?
Yes, sir.
Chamatka clear. Chamatka clear. Chamatka.
Yes, sir.
Yes, right. Abhi, who is Abhi? Abhi clear?
Yes, sir.
Right. Rajalamai, these are the principles of insurance. Insurable interest. There should be legal right. Anjalamai, utmost good faith. Both parties need to disclose all the relevant information and then indemnity principle to come to the previous level. Insurance company pay compensation. Right. 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 Lamai. Now we can move into life insurance and property insurance. Okay, ne? Right, right. Right, Lamai, we'll get 5 minutes break, huh? We'll get 5 minutes break. 9:45 will start life insurance, huh? Have a 5 minutes break, huh? 5 minutes. Right, Lamai, we'll start. We'll start. Right, what we discuss after now, we discuss a meaning of insurance, parties involved in insurance contract, principles of insurance. Right, then now we can move into life insurance and property insurance. Now, insurance basically we can divide into two: life insurance and property insurance. Okay, insurance basically we can divide into two: life insurance and property insurance. In life insurance, we can insure our life. Okay, in life insurance, we can insure our life. In property insurance, we can insure properties. We can insure properties. Right? Life insurance long term for 10 years, for 20 years, for 25 years. You can get life insurance coverage. Life insurance long term. Life insurance long term. But property insurance students short term. Normally, we can get property insurance only for 1 year. Only for 1 year. Only for 1 year. Okay. Life insurance normally we can get for 10 years, 20 years, 25 years. But property insurance 1 year. 1 year. Now, life insurance is some kind of investment, saving. Life insurance is some kind of saving and investment. Saving or investment. It means insurance after the maturity. Let's say you have obtained a life insurance for 20 years. After completing 20 years, you can get money. You can get money. If insurance company agree to pay us 20 million, if something happened to us, Then now, if something doesn't happen to our life after completing 20 years or 25 years, after completing every time period, we can get that agreed amount. Insurance company agreed with us. If something happened to us, they will pay 20 million to us or our dependent. Or if not, if you have completed, if the insurance agreement matured, if you complete, let's say 20 years, if you completed 20 years, if something doesn't happen to you, we will pay that agreed amount. We will pay that agreed amount. Insurance company pay that agreed amount. It means something happened to our life or not, they pay the agreed amount. They pay the agreed amount. If something happened to us before maturity, they pay that amount to us. Before maturity, before completing 20 years, they pay agreed amount. If we have completed 20 years, and then also they pay us agreed amount. They pay us agreed amount. So students, insurance is some kind of saving, some kind of investment. Saving or investment. Life insurance. Okay. After maturity means after completing 20 years, they pay agreed amount us. Or if something happened to our life before maturity, they pay, and then also they pay compensation to us. Okay. Right. And then in life insurance, indemnity principle is not applied. It's not applied. Only insurable interest and utmost good faith. Right, Kamai? Go to the page number 20, life insurance. Go to page number 20, life insurance. Life insurance. Binili, read this note, life insurance, Binili.
Insurance provide a vital service for individuals. If an insured dies prematurely, his dependents can obtain the compensation from life insurance. Life insurance covers the risks associated with the life of an individual. Life insurance is also termed as life insurance. Life assurance.
Insurance provide vital service for individuals. Vital service. If an insured dies prematurely before completing agreed time period, before completing 20 years, or 25 years, or 30 years, before insured dies prematurely, his dependents can obtain the compensation from life insurance. Their dependents, their children, wife can get compensation. But okay, right now here, life insurance covers the risk associated with the life of an individual. Life insurance is also termed as life insurance. If he dies prematurely, his dependent can get the compensation. But if the insurance policy matured, and then also he can get the agreed amount. And then also he can get the agreed amount. Agreed amount. Life insurance covers the risk associated with the life of an individual. Life insurance is also termed as life assurance. Life assurance. Ramai, 15, 20, 25 years ago, Union Assurance Company, Union Assurance. Union Insurance Company advertise their insurance company as Union Assurance, not insurance. Okay. Now, for the life insurance companies, they can use assurance, Selico assurance for the life insurance. But now, commonly they use insurance. Okay, insurance word, but life insurance. Okay, for life insurance, so, for life insurance, those insurance company, okay, they can say life insurance as life assurance. Life assurance. Another term for life insurance is life assurance. Okay, right. Another one here. Accidents, health issues, surgeries undergone by individual and hospital charges, etc., can also be included as additional covers to life insurance contract. Additional covers by paying some extra amount. By paying some extra amount, you can get these additional coverages. Accidents, coverages, health issues, surgeries, okay, hospital charges, that kind of additional covers you can get by paying some additional amount. Okay, right. Quickly we'll discuss some importance of life insurance. Okay, that's the last part of the day. Right, now importance of life insurance. What's the first one? First one, Lena. Lena, what is first? Lena.
Can be used as a method of saving or investment.
Yes, now we can use insurance, life insurance agreement as a method of saving or investment. Why? After maturity, insurance company pay agreed amount to us. Then we can consider it as an investment or saving. Amrit, second one, Amrit.
If the insured survives until the policy matures, the other benefit.
And then here, if the insured survive until the policy matures, the insured can obtain the insured value and other benefits. If you matured insurance policy, then you can get the agreed amount from the insurance company. Right, third one, AD.
If the insured dies prematurely, the named dependents can obtain the compensation.
Yes, if the insured dies prematurely before completing the insured policy, before the agreed time period, named dependents can obtain the compensation. Okay, right. Next one, fourth one, Abhi. Yes, Abhi, fourth one.
Can obtain financial assistance in case of marriages and education of children.
Now I can obtain financial assistance in the case of marriage and education of children. Okay, right. Financial, okay, they provide some kind of in Selico family summary, also some additional benefit. Okay, right. They provide some additional benefits are there in life. And then you also can obtain financial assistance in the case of marriage and education of children. They provide scholarships as well. Scholarships. Right. Fifth, last one. Abdullah. Last one.
Can be used as a collateral when obtaining loans from financial institutions.
Yes, Ramay. When you're obtaining loans from financial organization, you can use life insurance policy as a security. Okay, you can use life insurance policy as a security to obtain loans. Okay, but now when you're keeping life insurance policy as a security, there are some terms and conditions that you need to complete. Okay, some terms and conditions are there. But anyway, theoretically, we can keep life insurance policy as a collateral. Collateral means security to obtain loans. Okay, right. Then what are the importance of life insurance? What are the importance here? Can be used as a method of saving. If the insured survive until the policy matures, the insured can obtain the insured value and other benefits. Third one, if the insured dies prematurely, the named dependent can obtain the compensation, can obtain financial assistance in the case of marriage and education of children, can be used as a collateral when obtaining loans and loans from financial organizations. Right. Now, those are the importance of life insurance. Right. Okay, now right. Then enough for the day. Enough for the day. Next week we will discuss property insurance. Okay, now next week we can move into communication. Communication. We will complete communication next week. Okay, right. Now enough for the day. Enough for the day. We'll meet at next Thursday. Okay, now right. Right, now good night. Enough for the day. Good night. Right.
Good night. Thank you, sir.
Okay, right. Good
Thank
night.
you.
Okay.
Good night.
Okay, right. Thank you.
Thank you, sir.
Okay, right. Good night.